Hi, it's Jasmine Hunter, MBA EA, and I am here with another video to help you DIY your business accounting. So today we're going to be covering how to pay yourself and report income. A small business owner that has elected to be taxed as an S-Corp. You are ready to book your free consultation today. Go ahead and scan that QR code and it'll take you right to my page so that you can book your free consultation. Your personal goals are going to go a long way as to how you are going to be paying yourself through this entity. An S corporation is going to be a great choice if you are looking to show W-2 income and you want to buy a house. Perhaps you are interested in retirement. This is going to make that an easier vehicle to take advantage of. It's going to be easier to create generational wealth, and it's going to lower your tax liability compared to a sole prop. You want to definitely evaluate your business goals. So what are you trying to do? Are you trying to take advantage of more tax strategies? Are you trying to grow your business? Do you want to be able to easily leverage your business without having to use your personal income? Do you want to borrow more money? Are you trying to scale and grow your business? Again, are you trying to create generational wealth? Okay. Are you looking to hire your children in your company and pay them through your company? So these different business goals definitely are going to shape the process and the decision on how you're going to structure your business from a tax perspective. So with this tax structure, it can be either a single or multiple member LLC that has elected to be taxed as an S-Corp. S-Corp is going to be earning income from providing services or selling products. And then once you get your income, you're going to need to figure out how to pay yourself. So the owner is the shareholder and an employee of the business. So as a result, the owner has to be paid a reasonable salary or reasonable compensation for all services that are rendered to the business. In addition, there will be a distribution of profits to the shareholders based upon how much the business profits at the end of the year. And this is called an owner's distribution. Business income, right, comes into the business. It is going to go out to multiple different accounts, but two of the accounts that we care about today is your payroll account. So this is an account separate from your income account. In this account, you're going to include your employee salaries and your payroll taxes. From the employee salary, you are going to be withdrawing the employee's portion of the tax. So their withholding that has to be paid off to the federal and state on their behalf. You're going to get that from the W-4 that you have them fill out when they are first hired. Also from the employee salary, you're taking out any deductions that they have. So any garnishments that they may have, health insurance, HSA, retirement, group term life, anything that the employee has elected to participate in, their portion of payment is going to come from the employee's salary and deducted from how much they earn. The next account that you may want to use, account that you should use, is an owner's equity account. So because distributions are limited to the amount of profits that is earned by the business, it isn't advisable to take owner's distributions as frequently as you did when you were a sole prop. You want to wait and to withdraw money from the business as a distribution until you know how much profit the business has, and then you can draw the distribution from there. So having this separate owner's equity account where you can just put the distributions that you believe you should be earning, doing that quarterly based on the profits, and waiting until the end of the year to distribute is going to be better than taking out too much and being penalized for it. So for taxes for an S corporation, remember that an S Corp is a pass-through entity, meaning that an S Corp isn't responsible for paying any income taxes itself. All income must be passed on to the shareholders of the company. The owner's salary, as well as any other employee salaries, are going to be a deduction of the business. Employer taxes are withheld and remitted from your business payroll. This is typically going to be done monthly or bi-weekly, depending on how much tax liability you have when you are paying the employer taxes. Remember that taxes are pay as you go. So as you earn these income, you should be paying tax on the income to the federal government as well as the state if your state has income tax. Estimated taxes for the entity are unlikely because this is a pass-through business. So they don't owe tax, they won't have to remit estimated taxes. As an employee, however, you may have to pay estimated taxes depending on if you did your W-4 correctly or how much your distribution is. And again, the distribution is limited by the profit of the business. So the distribution is listed on the K1 among other things. And then everything that you earn during the year, your owner's compensation, you are going to get a W-2 for that from the business so that you can report that income. The entity typically doesn't pay any taxes. Some deductions, the income and credits are going to pass through to the shareholder. So all of that is going to be reported on your Schedule 1 for you to claim when you do your individual taxes. You're going to pay less in employment taxes as an S Corp than you would if you were a sole proprietor, because the amount of salary may be limited as you're able to split earnings between salary and distribution. The effective tax rate is going to be lower because there is no self-employment tax. Remember, employment payroll taxes are being paid by the S Corp as they are earned. So that separate amount that is added onto your income tax rate at the individual level is no longer being added because it's already being covered. You do have a filing requirement as an S Corp. So whether you earn income or not, you are required to file a return each year. And just know that tax preparation and planning services are going to be more expensive for the entity type than if you have a sole prop. Here are the forms that you'll be using for your S Corp taxes. So the return has to be filed on an 1120S. Okay, this is the federal form to report your income. From here, you're going to generate the K1 and issue this to all shareholders. So if this is a single member LLC, you're just issuing it to yourself. If it's a multiple member LLC, you're sending out a K1 to each shareholder. And each shareholder is then going to file their 1040. They're going to use their Schedule E to report the K1 income or loss and deductions that were passed through. And the 1040, you're going to report the salary that you earned from the business. So if you still have questions or you would like specific tax advice for your business, as this has just been for educational purposes, this is general information, and you want something custom for your particular business and your situation, please scan the QR code and book a free consultation. I can help you set up your payroll and analyze your business to get you into the best business structure to reduce your tax liability or help you with your personal goals and achieving those. This has been Jay Hunter MBA, Jasmine Hunter MBA with Hunter Virtual Bookkeeping and Tax. It has been my pleasure to help educate you on how taxes work for an S Corp.